Hello, Profit Hackers. I'm Jeremy Lott, the Chief Visionary for Foundation Accounting and Consulting. I owned a construction company for about 15 years before making a change to accounting because my accountants sucked. My goals are to simplify accounting for construction company owners, fuel your profits, level up your cash flow, and help you grow in a financially responsible way. So let's go. Hello, Profit Hackers, and welcome back to the Contractors Profit Hack Show. I'm Jeremy Lott with Foundation Accounting and Consulting, and I am here talking about how to scale without going broke. Part of that process is tracking the right numbers to help us understand the health of our business and how we're doing, right? So today, we're going to continue talking about ratios, and we are going to address days in accounts receivable, okay? So a quick story. Back when right after I had turned 19, I had two really good friends. They were twins, the Kemps. And for my birthday, they bought me two tickets to the Tom Petty concert that was coming into town, right? So we're talking 1995 Tom Petty concert in Salt Lake City, Utah. I was super excited about this, and I found a date and picked her up, and we went to the Tom Petty concert. Well, about halfway into the concert, it was fantastic. Loved it. Super entertaining. She was great. But about halfway into the concert, I tapped my pocket and realized I didn't have the keys to the truck that I'd driven. My dad's little Chevy S10. I did not have the keys in my pocket, which meant one thing. I had locked the keys in the car. I had panicked and didn't know for sure what to do. And then a thought occurred to me. You know what? If I can text my parents, and yes, this was the starting days of being able to text, but that was back when you had to, tap the number 2 3 times to get a C, right? And so I texted my parents really quickly and said, hey, I locked my keys in the car. This is where I'm at. They knew where I was at, but this is where I'm parked. Is there any way you could go unlock the truck for me? And they did. I wanted it done as quickly as possible, as soon as possible, right? And they did. They drove up, they unlocked the truck, and the concert ended, and I went out to the truck, and I was able to open the door, and the keys were there inside, and I was able to, start up the car and drive home, take my date home, and we had a lot of fun, and I was spared the embarrassment of having locked the keys in the car and trying to figure that out after the concert, right? So it was fantastic. It was a great thing that my parents did. I appreciate their sacrifice to come do that for me and take care of me like that. But the point here is that I wanted it done really quickly, right? I want to compare that to our days in accounts receivable, which is the next ratio that we're talking about here. This ratio is all about how fast can I get paid, right? And just like me wanting my parents to go unlock the car as fast as possible, we want to be able to collect our money as quickly as possible, right? Because the longer that we have to go between collecting, the longer it's going to stretch out our cash flow. Okay? So we want to collect as quickly as possible. And the way that we track how quickly we are collecting and how that's changing over time is the ratio called days in accounts receivable. Okay? So for days in accounts receivable, the way that we track this is first, we're going to take our average accounts receivable. Then we're going to divide it by the actual term is credit sales, but we're just going to look at revenue in general, right? With the exception of service companies, your plumbing, your HVAC, your electrical, your landscaping, with the exception of those that are doing service, we are going to be billing people and then collecting at a later date, right? And so with that in mind, we want to start off with our average accounts receivable. Now, how do you figure out an average? You add up the numbers, you divide by the total numbers, right? So what we're going to do in this case to figure out our average accounts receivable is we're going to look at what was our accounts receivable January 1st, what was our accounts receivable December 31st. We're going to add those two numbers and divide them by 2, right? Just an average. Beginning accounts receivable January 1st, ending accounts receivable December 31st. Add those two numbers, divided by 2. That tells us on average how much we had in accounts receivable throughout that year, right? So we have the average accounts receivable. Then on the bottom, we have our revenue, right? Particularly the revenue related to credit sales. So the revenue related to invoices that we're sending out, right? If we're collecting cash at the time, we don't want to include them in that total revenue number. But again, like I said, unless you're doing service, most likely you are doing the work and then invoicing somebody to get paid, right? And so we have on the bottom our total revenue. Now, when we're looking at these two numbers, right, which number is our champion here? Which number do we want to focus on? Do we want to have a higher number in accounts receivable, our average accounts receivable or amount that we need to collect? Or do we want to have a higher number in our revenue? In this situation, our champion is the revenue. We want to have a higher revenue, right? Because we don't want our accounts receivable to be big. We want to get paid quickly. We don't want a high average accounts receivable. We do want a higher revenue, right? So our champion in this case is the bottom number, the revenue, which means that we want our result to be smaller. The smaller our result, the better the number is, right? So we take our average accounts receivable, we divide it by our revenue over that same period of time, and that gives us a percentage, right? A ratio, and we want that number to be as small as possible. Well, now the cool thing is we can take that number, whatever it is, and we can multiply it by the number of days in that period. So if we're looking at a year, it's 365. If we're looking at a quarter, it's 90, right? We can look at those total we can take that percentage and multiply it by the number of days in that period. So if we're looking at a year, 365, and the result is an average of how many days an invoice takes us to get paid. Okay? Does that make sense? I hope it does. This helps us to know how long it takes us to get paid on average. We send out the invoice here. We get paid over here. What is that time? That's what we've just gone through here, is what is that period of time, right? And how to calculate that. So we definitely want to focus on having a lower number. And if we know how to calculate that, we can track it over time and be able to see how well we're doing at improving our collections, right? If the number of days goes down, that means we're collecting faster. And that's a good thing. We want to collect our money as soon as we possibly can. Okay? So there's days in accounts receivable. Next, we're going to talk about days in accounts payable and why that's important to track, right? Hopefully this was helpful for you. We're trying to keep it simple. We're trying to keep some simple numbers here and explain things in a way that anybody can understand what's going on. It's so much easier with a picture. If I could draw a picture here for you, I would. If you want me to draw a picture for you of this, then reach out to me and we can have a conversation about it. But days in accounts receivable, important to track. We want that number as low as possible. Thank you very much, and I will talk to you next episode. Thanks for listening. If you found this episode helpful, please like and subscribe for weekly episodes to help you fuel your profit, level up your cash flow, and finance your growth. Until next time, go enjoy some green M&Ms and protect that cash.